Let's take a closer look at tech with big earnings on deck this week. Joining us now, Dan Morgan's a VP and Senior Portfolio Manager with Synovus Trust, and Aaron Kessler, an analyst with Raymond James. Guys, good morning to both of you. Aaron, a couple of your top picks are Alibaba and Facebook, and these stocks have been behaving very differently. I'm not sure exactly why you think Alibaba has been behaving the way it has. I think it's up a little less than 20% over the past 12 months, which actually makes it a relative laggard among big tech companies. Why is that a big pick for you, and where do these companies fit in the overall narrative that you see playing out?
Yeah, so Alibaba, it has consolidated a little bit more recently. If you remember, last year's up roughly 100%. So partly, I think it's consolidating gains. There has been some nervousness around China with tariffs. We don't think that actually impacts Alibaba that much, but it has been a concern. As well, you've seen some devaluation of the renminbi recently, the Chinese currency, around 6% over the last few months here. So that's weighing on the stock a little. But overall, we look at the company growing 40% on their core retail business, trading at 17 times kind of core earnings here. We think that's too cheap. We have a $300 target. We would be strong buyers at these levels of Alibaba.
Dan, well, I was just asking Mike what he thinks investors writ large need to hear from big cap tech this earnings season. I'm curious what you think Alphabet investors specifically are going to want to hear from that company. What's going to move that stock? Does it have to do with more detail around cloud? We started to get the first detail with that $2 billion annual run rate. Or does it have more to do with just overall top line growth, same thing they're looking for from Amazon?
Well, John, I think the key to the upcoming Google report is going to be not only what, as you mentioned, cloud is doing, their Google GCP, which competes against AWS and Azure, but also in terms of what's going on with their traffic acquisition costs. We know in the last quarter, when we look at that other revenue category, we know that YouTube is a big part of that. How much is that cost impacting their gross margin? We're actually looking for gross margin to drop down to about 72% on this upcoming quarter. So I think we got a little bit of a scare in the first quarter in regards to traffic acquisition costs as it related to that other revenue category. So I think we're going to focus on two things. We're going to focus on what's going on with GCP, and we're going to focus on how traffic acquisition costs are being impacted by what's happening with YouTube. And I think that's where the street's going to really zero in.
You know, and John, another secondary piece of it is these companies have to persuade investors that they still have high return investment opportunities with the capital that they have right now. So I think that's why Amazon kind of gets to be center stage, because that's always been the question. I mean, they seem to never lack for the next thing to go after. And if people can be satisfied with the returns that they're likely to get off of that, that's probably something I think from a very 10,000 foot level, that is a question.
Aaron, is this more of a cost quarter where investors are going to want to be sure that companies are maintaining cost discipline, that they're not overly affected by things like tariffs, or is it more going to be one of those top-line growth quarters based on perhaps what we saw from Microsoft? Investors wanted to see that PC growth translating to them, and I think they overperformed in that arena. Also, the cloud growth, et cetera. Is it more on the cost side or on the revenue side?
Yeah, I mean, clearly both are going to be important. I think it's company by company. I think on Google, you're going to see expense growth was a big concern last quarter, both traffic acquisition costs as well as operating expenses. I think we're going to want to see a little better leverage as we go into Q2 here on Google. As the company alluded to, traffic acquisition costs should slow in Q2, so we'll be watching for that. Amazon clearly still gets the benefit of, as long as they can produce strong revenue growth, and they've started to show some incremental leverage both in the core business, the advertising line, really good Prime momentum. I think investors still primarily focused on top line on Amazon, but we would want to see improving leverage with that story as well. But clearly, with valuations up, if we look at our universe, large cap about 7% above the 3-year average for EBITDA multiples, and small caps about 30% above. So actually, large caps we still think are pretty reasonable at these levels here.
All right, Mike, any closing insights based on how we saw investors react to Netflix, IBM, Microsoft, what they're looking for?
I was going to say Netflix. I mean, first of all, it was such a clear miss based on their own forecast that I'm not sure you can necessarily extrapolate to Amazon. But I do think the reaction is going to be the tell. It's going to be the tell for whether people are leaning too far in the direction of, hey, Amazon's been the lead dog of this entire market this year, and can it continue that, or is it time to say, you know, we already kind of priced it in? So that's why I think the response matters a lot when it comes to Thursday.
We will see. Dan, Aaron, thanks, and of course our own Mike Santoli.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.